Over the last 15 years, the S&P 500 has returned about 470%. Meanwhile, both SCHG and VUG have nearly doubled that. These two ETFs have absolutely crushed the broader market over the past decade and a half and have both raked in billions of dollars since they've been launched. Now, they look almost identical on paper, they both track US large cap growth, and they both cost essentially nothing to own. But there is a small difference between them that matters more than most people think. So let's break down which one of these two ETFs you should actually own. Today, we're going to cover where these two funds sit in the growth ETF space, the methodology between each one, what each fund actually holds, and how they performed over the long run. Then I'll close with my honest take on which one I would pick today. And if you currently own both these funds, I'm going to make the pretty strong case that you should pick one of these and sell the other one. Now let's get into it. US large cap growth is one of the largest and most traded categories in the entire ETF market, and there are really only a handful of funds that dominate the space. VUG, the Vanguard Growth ETF, is the giant at over $213 billion in assets. The iShares Russell 1000 Growth ETF, ticker symbol IWF, is technically second by AUM, but its 18 basis point expense ratio has kept it from really catching on with the retail crowd. SCHG, on the other hand, the Schwab US Large Growth ETF, sits at third at roughly $55 billion and is one of the fastest growing funds in the entire industry. Now, you may be asking me why I'm comparing these two specific funds. VUG and SCHG are by far the two most popular large cap growth ETFs with retail investors specifically. If you're holding a growth ETF today, there's a really good chance that it's one of these two, and if it isn't, these two are very likely the ones that you're considering. So let's get into them. So the main difference between these two funds come down to methodology, which is just a fancy word for the rule book each index uses to decide what stocks are worthy to be a part of its portfolio. VUG tracks the CRSP US Large Cap Growth Index. CRSP starts with the largest 85% of US stocks by total market cap. Then it scores companies on 6 growth factors with things like long-term and short-term projected earnings growth, 3-year historical earnings growth, 3-year sales growth, current investment to asset ratio, and return on assets. It then weighs those scores against 6 value factors and assigns each stock to either the growth bucket or the value bucket. SHG, on the other hand, tracks the Dow Jones US Large Cap Growth Total Stock Market Index. The Dow Jones starts with a smaller universe, just the largest 750 stocks by market cap, and uses its own 6 factors, which lean heavier on sales per share growth, projected earnings growth, return on equity, price to book, and price to cash flow ratios. Its scoring system is also a little bit looser around the edges, so the names that don't quite make VUG's cut make SHG's cut. Once again, it's the same category, the same idea, but has 2 different rule books, and that single difference is what creates the holdings divergence we're about to walk through. Before we dive into the holdings, the most important thing to understand right out of the gate is that these funds are actually 79% identical by weight with a 0.99 correlation, which means they basically move in lockstep. The real question here today is what's in that 21% that isn't identical, because that's where the decision actually lives and the performance diversion actually happens. So both funds hold a large chunk of their portfolios in the top 10 names. SHG sits around 59% concentration in its top 10, and VUG is at roughly 64%. And those top 10 names are nearly identical between the two funds. Think of the top names like Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, Broadcom, Tesla, and Eli Lilly. So whether you pick SCHG or VUG, roughly 2/3 of your money is going to the exact same place. The actual decision is about the other 35 to 40% of each portfolio. Now, SCHG holds 196 stocks, while VUG holds about 155. So SCHG is naturally a little bit more diversified outside the top 10. And the cleanest way to see what that produces in the performance is at the sector level. So VUG is roughly 52% technology, while SCHG is roughly 46%. Both are obviously still tech-heavy funds, there's no question about that, but SCHG makes up that 6-point difference with more healthcare, more financials, and more industrials. Now, these sectors behave very differently than tech in different parts of the market cycle. Specifically, SCHG holds names like United Health Group, Thermo Fisher, GE Aerospace, BlackRock, and Progressive that VUG either doesn't hold at all or holds much smaller amounts. VUG, on the other hand, leans further into the second-tier mega caps with names like Oracle, Lam Research, and Applied Materials. So in all, both funds give you the same Mag 7 at the core, but the decision really comes down to what you want sitting underneath that core. And there is an actual actual cost to that concentration with VUG, its weighted PE ratio is at 37 compared to 34 at SCHG. Now the PE ratio just measures how much investors are paying per dollar of company earnings. So the higher the PE ratio means the more expensive valuation of those companies. Now what that tells you is that VUG investors are paying about 8% more for nearly the same growth exposure. Now let's talk about how these two funds have actually performed against each other. As of end of Q1 2026, VUG is up 18.3% year over year, with SCHG at 16.8%. Over 3 years annualized, SCHG is at 21.9% and VUG is at 21.2%. Over 5 years, SCHG is at 13% and VUG is at 11.8%. And over 10 years annualized, SCHG is at 60.9% and VUG at 16.1%. And from 2015 through 2025, SCHG beat VUG in 7 out of the 11 calendar years. Now, to view the performance discrepancy in another angle, if you invested $100,000 in each fund 10 years ago, SCHG would have grown into about roughly $477,000, while VUG would have grown into about $445,000, which is roughly a $30,000 difference. Now, this is also taking into account that SCHG charges 1 basis point more in expense ratio. SCHG charges 4 basis points, while VUG charges 3 basis points. Now, if you guys are getting any value out of this, please go ahead and hit the subscribe button. I break down single ETFs or do ETF comparisons like this every single week. Now let's get to the part that actually matters, which is my honest take. So if I were picking one of these funds to add to my portfolio today, it would be SCHG, and here's why. Now, the first reason comes down to the methodology and what it actually produces in the portfolio. Because the Dow Jones index that SCHG tracks pulls from a slightly different starting universe and uses a different scoring system, you end up with a fund that gives you a bit more exposure beyond the Mag 7. So to me, I prefer that a little bit more compared to just stacking the mega cap on top of more mega cap. The second reason is the valuation. As we covered earlier, VUG is paying an 8% premium on the price to earnings ratio for the same core holdings essentially, and I'd rather not pay when I don't have to. Now, who is VUG actually built for? If you prefer the heavier Mag 7 weighting and you want more concentrated bet on the largest mega cap names in America, then VUG is obviously the better choice for you. Now, choosing VUG, you also get the Vanguard brand, which a lot of investors specifically prefer because they trust them. And of course, VUG is also 1 basis point cheaper on the expense ratio, which as we covered isn't going to make or break your returns, but if you optimize for the absolute lowest cost, then it's a tally in VUG's column. But here's the most important takeaway from this entire video. If you currently own both SCHG and VUG, you should just pick one. They are 99% correlated. They share 79% of their portfolio by weight, so owning both really makes no sense since they provide the same style of investing to your portfolio. There's really no diversification benefit, there's no risk reduction, you're just paying twice for the exact same exposure. So pick the one that matches your thesis, sell the other one, and consolidate your holdings, in my opinion. Now drop a comment, let me know what you guys think. Do you own SCHG, VUG, or are you looking to make your decision today? Tell me which ETF you'd like me to break down next, or one-on-one comparisons just like this. Follow me on Blossom for my full portfolio, and subscribe to the Substack in the description for ETF breakdowns like this every single week.